Here is something you might not know. The raise you are going to see on your Social Security check in January 2027, that number is being decided right now, this summer. These 3 months we are in right now, July, August, and September. Not all the months you have been watching prices go up at the grocery store and the pharmacy, just these three. And once September is over, the math is done, and what you get in January is set in stone. Most retirees find out what the raise is going to be in October when the announcement comes. But here is what is important to understand. By the time they announce it, the decision has already been made. The decision is being made right now. So let's walk through how this whole thing actually works, what the raise is, how they calculate it, what we think the 2027 number might be, and most importantly, why the raise that hits your bank account in January almost always looks smaller than what they announced in October. And most importantly, the mistakes that cost retirees real money when they do not understand these mechanics. So grab a notepad and let's get into it. Let us first understand what the raise actually is. The official name is Cost of Living Adjustment, or simply COLA. But really, it is just a once-a-year increase to your Social Security check that is supposed to keep up with rising prices. Before 1975, there was no automatic increase. If retirees were going to get a raise, Congress had to vote on it, which meant some years you got something and the other years nothing. And it was often more about politics than about what prices were actually doing. In 1975, they changed the law so the raise happens automatically every year based on inflation. The idea is simple. If prices go up by 3%, your check goes up by roughly 3%. So your money buys about the same amount this year as last year. Whether it actually accomplishes that for you personally is a different question, and we will come back to it. But that is the purpose. Not a bonus, not a reward. A mechanical effort to keep your purchasing power from shrinking as the cost of everyday items rise. Here is how the government decides the number. There is an inflation tracker put out by the Bureau of Labor Statistics, a federal agency that monitors prices across the country, called the CPIW. Think of it as a shopping basket of everyday goods and services. They check what that basket costs every month and track how much prices are changing over time. Now, they do not use the whole year for the COLA calculation. They only look at 3 months, July, August, and September. They take the average price from those 3 months this year and compare it to the average from those same 3 months last year. Whatever percentage prices went up is your raise, rounded to the nearest 0.1%. That is it. That is the whole formula. So for the 2027 raise, they are comparing July through September 2026 prices to July through September 2025 prices. The 2025 numbers are already set in stone. Right now, the 2026 numbers are being collected. Once September is over, they run the math, and the answer is your raise. One thing worth knowing is that if prices do not go up, you do not get a raise. Your check stays the same, it never goes down. But if inflation is flat or negative, the increase is zero. That happened in 2010, 2011, and again in 2016. So what are we looking at for 2027? Nobody knows the exact number yet. That comes in October. But based on what inflation has been doing this year, a few respected organizations have put out their early estimates. AARP, you probably know them, is projecting around 3.6%. The Senior Citizens League, a nonpartisan group that specifically advocates for retirees, is on the more conservative end at around 2.8%. Most analysts land somewhere in the middle, around 3.0% to 3.2%. If there are major price shocks this fall, tariff increases hitting consumer goods, energy spikes, things like that, the number could push toward 4%. If things stay calm, it will likely stay in that 2.8% to 3.2% range. Now, let's put real dollars on those numbers because percentages are hard to feel. The average Social Security retirement check right now is about $2,025 a month. At 2.8%, that goes up by about $57. At 3.2%, it is about $65 more. At 4%, you are looking at about $81 extra a month. Write those numbers down because there is something important you need to know about them. Those are the gross numbers, before deductions. What actually hits your account is going to be less. Let me tell you why. Most retirees have Medicare Part B, that is your doctor and outpatient coverage, and the premium for it gets automatically pulled out of your Social Security check before you ever see the money. Every year, Medicare also adjusts its premiums. And here is the thing. Medicare's premium increase and your Social Security raise are calculated completely separately. They do not have to match. And Medicare's increase comes right off the top of your COLA. Last year, the Part B premium jumped from $185 to $202.90, nearly $18 more a month. The Social Security raise was 2.8%, which added about $56 on average. So the net real gain for most people was around $38 a month, not $56. For 2027, the early estimate is that the Part B premium goes up to around $209.50 to $213 a month, about $10 more than this year's $202.90. So if your 3.2% COLA adds $65 to your gross check and $10 comes right back off for the higher Medicare premium, your actual take-home increase is closer to $55. That is still a raise. And $55 a month is real money. But it is not what the headline number looks like, and you deserve to know that before January arrives, not after. Now, there is a protection in the law called the Hold Harmless rule. It basically says your Social Security check cannot go down from year to year just because Medicare went up. If Medicare's premium ever rose by more than your COLA dollar amount, the law caps the Medicare increase so your check stays flat rather than going negative. That protection has helped a lot of retirees in years when COLA was tiny or zero. However, Hold Harmless has limits. It does not protect higher income retirees who pay IRMA surcharges on top of the standard Part B premium. It does not protect people who pay their Part B premium directly rather than through benefit withholding. And it does not protect new Medicare enrollees. For everyone outside those exceptions, the protection is real, but it only keeps you flat, not ahead. Now, I want to talk about something really important, and it is something a lot of retirees feel but do not always have the words for. A raise comes every year, and yet the money still does not seem to go as far as it used to. Prices at the grocery store, homeowners insurance, prescriptions, those feel like they go up faster than the raise does. That feeling is not wrong. The inflation tracker used to calculate your raise was designed to measure prices for working-age people, commuters, people buying work clothes and lunches out and public transportation to an office. Retired households are not part of that sample. Retirees were specifically excluded from the CPIW formula. Because of that, your raise is calculated based on a spending pattern that is not yours. Retirees spend a lot more on healthcare and housing as a share of the budget than working-age folks do. And healthcare in particular has been going up faster than general prices for years. There is actually a separate experimental price index called CPIE, the E stands for elderly, that gives more weight to medical care and housing costs. Independent researchers have found it tends to run a little higher than the CPIW. But as of right now, the law still requires Social Security to use CPIW. That is not something any individual can change. But understanding it explains why a 3% raise does not always feel like a 3% raise when you are living in retirement. Now the mistakes worth avoiding. Here are the ones that come up most often, and any one of them can quietly cost real money. Mistake 1. Budgeting off the headline percentage instead of the net dollar amount. Always do the simple math. Take your gross COLA increase in dollars and subtract the Medicare premium increase. That is your real raise. Build your budget around that number, not the one they announce on the news. Mistake 2. Not knowing whether you pay extra Medicare surcharges. These are called IRMAA, Income-Related Monthly Adjustment Amounts. If your income from 2 years ago was above $106,000 as a single person, or around $212,000 as a couple, you are likely paying extra on top of the standard Part B premium. If there was a one-time income spike in 2024, a property sale, a large IRA withdrawal, a Roth conversion, that could push your 2026 Medicare premiums higher, even if your regular income is lower now. The good news? You can appeal it. Contact Social Security and ask about a life-changing event appeal. They can look at your more recent income instead. Mistake 3. Treating the whole COLA as bonus money. Some of it is simply keeping pace with the higher prices already being paid. A raise that exactly matches personal inflation does not leave more spending room. It keeps things even. Think of COLA as inflation protection first and extra spending money second. Mistake 4. Forgetting about taxes. A larger check can mean more taxable Social Security. If combined income from all sources plus half of Social Security is over $34,000 for a single filer or $44,000 for a married couple, up to 85% of Social Security becomes taxable. A slightly larger benefit can quietly move into a higher tax bracket or trigger higher Medicare surcharges the following year. This is worth a conversation with a tax preparer before year-end. Mistake 5. Not running a personal inflation number. Add up what the most expensive categories, healthcare, housing, utilities, insurance cost this year versus last year. Compare that to what the COLA actually delivered. Knowing the personal gap helps with realistic planning instead of being surprised every February. Mistake 6. Not looping in a spouse or family. If a household depends on 2 Social Security checks, both are changing in January. And if something happens to one spouse, the surviving partner may inherit a different benefit than what is currently being received. Reviewing the changes together, not just individually, is worth doing every year. Now, how to estimate your own 2027 raise right now. There is no need to wait until October to get a rough idea. Take the current monthly benefit, the gross amount before Medicare comes out, and multiply it by 0.028 for the low scenario, 0.032 for the middle scenario, or 0.040 for the high scenario. That gives an estimated gross increase. Then subtract roughly $10 for the projected Medicare Part B premium increase. What is left is the estimated net monthly raise, the real number to put in the budget. For a more precise projection, go to ssa.gov and use the retirement estimator. It pulls from an actual earnings record and lets you model different scenarios. And in December, Social Security will mail a formal notice showing the new gross benefit and updated Medicare deduction. Do not throw that envelope away. Open it, read it, and make sure the numbers make sense. If something looks off, call 1-800-772-1213. They can walk through it. The official announcement is around mid-October. Between now and then, these 3 summer months are the ones that decide the number. Now you know exactly what that number means and what to expect when it arrives. So, if you find this video helpful, consider subscribing. It really means a lot. Take care, and I will see you in the next one.